The whole point of gold is that you have the right to take your marbles home. And it's the opposite of centralized. The dollar is centralized. Gold absolutely is not. Gold is for that portion of your savings that you don't want to have at risk.
Please join us for our next live stream Sunday, December 11th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, December 11th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Keith Weiner, founder and CEO of Monetary Metals, joins us today. Monetary Metals is an investment firm unlocking the productivity of gold and even pays interest on it. Most people regard gold as a dry asset to lock away in a vault, incurring storage fees, and many are waiting for it to rise in price. Keith and Monetary Metals are on a mission to change this. And we are delighted to have Keith join us here once again today. It's time to saddle up and silver up for Keith Weiner. Keith, welcome back to SBTV. How are you doing?
Doing good. Thanks for having me back.
Glad to have you back and back in Singapore again. How's everything going for you in Singapore this morning?
We seem to keep doing this. I'm in Singapore, but we're actually a few miles apart, not in the vault as we did on the first one. But life is good. Singapore is a very cool place.
All right, we'll make it a point to get in that vault for sure. Uh, Keith, I want to start off by revisiting a fairly recent debate you had at the Mises Institute. You said how stocks, real estate, fiat currencies, bonds, and Bitcoin were all chips in the Fed casino. Can you expand on this?
Yeah, the Fed has deprived the world of yield. That's what it means to drive the interest rate to zero. And of course, in Europe and Scandinavia and Switzerland and other places, they drove the interest rate negative. So you can't get a yield anymore. So people turn to a surrogate, which is speculation. You buy an asset, you hope the price goes up, and you sell it to the next guy for more than you paid. And hopefully repeat the cycle. Eventually, of course, the boom turns to bust. Everyone says that's when the losses are inflicted, but actually the losses are occurring all the way up. And then at the end, the accounting catches up to the reality. And so everybody has their favorite chip. Some people like to buy fine old wines, Baron de Rothschild, 1983, whatever. Some people like antique Ferraris. Some people like stocks. Some people like properties. Some people like Bitcoin. Some people like silver. But it's all, betting in the casino to try to get more dollars at the end of the day. And although they claim Bitcoin is money, it's you know it's been fantastic. It's skyrocketing and also crashing. And so those who know how to trade it, can make a lot of dollars in that trade.
Right, I'll touch on that in just a bit. And you also had said how gold is the only thing we have that is an economic constant. What is an economic constant and why is it important to have one?
So imagine in civil engineering if the length of a meter varied as you built the building and you went up floor by floor, and the meter starts out, at ground level, being, I guess I can't really do a real meter in this frame, but a meter is a real meter. And by the time you get to the 70th floor, a meter is like this, you know, 6 inches apart or whatever. So you'd end up with all the perversions of trying to say floor adjusted or height adjusted meters. It would be impossible basically to build either make the calculations for building to stand or to actually construct it. It would be completely impossible. Nothing would be stable or stand. Yet we put up with this. In fact, most normies, most muggles believe that this is actually better to have a flexible, elastic rubber band unit of account, a unit of measure that changes per monetary policy. And so we get used to the dollar, constantly having inflation, and you have to say, oh, I mean, $1992, not 2022. The 30 years ago dollar was a bigger dollar than today. Um, but actually, this messes up economic calculation and particularly long-term investments and the very kinds of investments that enable civilization to grow and thrive and continue to be up and to the right. Everything becomes distorted. So people think that properties are investments. You buy a house 20 years later, it's the same house. People say, my house went up. Well, perhaps it's actually the dollar with which the house is measured went down. So that starts to get into the question, okay, how could you measure economic value such that you can compare a 1992 price to a 2022 price? And what is it that you would use to measure? And the answer is gold, grams or ounces of gold is the closest thing we have to an economic constant. I make the argument, I put up a chart in this debate, and it was a chart of the price of gold over the last 5,000 years, and it was a flat line at 1 ounce. That is, the price of 1 ounce has always been. And people say, okay, haha, that's a tautology. No, no, no. What it's saying is that or rather, it's based on the observation that we have continually been mining gold for at least, as far as we know, 5,000 years. A friend of mine wrote a book called The Dawn of Gold that argues that man was picking, or Neanderthals, pre-man, was picking gold out of the stream beds in Europe 13,000 years ago. But so far as we know, it's been many thousands of years for sure that we've been mining this stuff. Gold is not consumed. So the gold just accumulates. Virtually all the gold ever mined in at least 5,000 years of human history is still in somebody's hands. People leave it to their kids, who leave it to their kids, give it to their temple in India, whatever it is, but it just accumulates. In any other commodity, accumulation is impossible. It's called a glut. If the wheat crop is 1% greater than whatever the agricultural experts, predicted, it's a calamity. The price crashes. Farmers stop planting wheat. Marginal users of starch, maybe it's wallpaper paste, switch to wheat, to work off the glut. There's no such thing as a glut in gold. It's accumulated without end, which means the marginal utility of gold does not diminish. The next unit, the nth plus 1 ounce of gold, is worth the same as the nth, is worth the same as the nth minus 1, is worth the same as the nth minus 2, all the way back. As far as we know, 5,000 years. Nothing else comes remotely close to that, except silver, which is remote, but sort of, kind of like that. Um, and so gold is a constant in that money is the only thing that can measure economic value. If you use money to measure itself, you see it doesn't diminish as its quantity increases. Contra the quantity theory of money, which says the value of a unit is 1 over n, where n is the number of units. We see the opposite behavior in gold. And so that's why I would call it or do call it economic constant.
Okay, thanks for explaining that. I can't get my head off imagining a Neanderthal man walking around picking up gold. A lot of rich Neanderthals back then. Maybe that's how the central bank started. I don't know. But
Are you
if
calling
in
Jay
that,
Powell a Neanderthal?
for the sake of YouTube algos, of course not. We love Jay Powell, right? In that recent debate you participated in between gold and Bitcoin, if I were there and had the chance to ask a question, I'd like your opinion on if Bitcoin were to be money, what happens to this money, or maybe I should say, what happens to the price of things such as a home when the last Bitcoin is created in 2140?
I don't think one has to look to the last Bitcoin being mined. That whole idea of a cap on the quantity, and they're trying to prevent dilution and so on. And they redefine money as something that has a provable quantity, a provable ledger, so you can know exactly how many units there are. That's not how real commerce is done. Nobody says I'm going to refuse your gold coin because I don't know how many gold coins there are out there in the universe. Um, so the problem with Bitcoin, and my opponent, Pierre Rochard, conceded this point, is that it's not stable. There is literally no mechanism by which Bitcoin could ever be stable. So its price is going up and down constantly, which means it can never be used for credit. It can't be used to finance real production. Who would borrow something that could go up 1,000-fold? I mean, imagine borrowing $1 million to buy a house, and then you owe $1 billion a few years later. I mean, that's nuts. So Bitcoin sits outside the world of finance, and its price is set purely by the marginal speculator. And so when the marginal speculator is hot, then Bitcoin is $69,000. When the marginal speculator is cold, it's $15,000. And who knows whether it'll be $1,000 or whether it'll be $1 million. Probably both and everywhere in between. And so what is your house going to be when priced in Bitcoin? Take the random number generator that is Bitcoin and divide that into the value of your house, and you get the price at that moment. And tomorrow it could be a very different price.
If you're enjoying this interview with Keith Weiner and I, please consider subscribing to our YouTube channel and let the algos know you'd like to see more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Right. Okay. Because the question I have, with let's say Bitcoin is money and the last one is mind and that's it. How does mankind then advance or grow by way of medicine, technology, its standard of living if the money supply does not reasonably grow with it?
That's a very good question. Um, the idea of a constant quantity of money um, would never work, in a real economy. I mean, it's great speculation, makes a great narrative for those who bought Bitcoin early and sold at high prices. Congratulations, and that narrative helps sell that story. But no, it would never work economically for that and many other reasons.
Well, since we're talking about quote unquote money, how would you define money?
So the first thing is we are physical beings. We're not some sort of detached consciousness cartwheeling through time and space, um, or detached consciousnesses in some sort of matrix. We are physical beings. We live in a physical world. Every day we need food and shelter and a pretty narrow band of temperature and oxygen and water and so on. We have to sleep at night. And so money has to be a physical thing. It's great to have a credit. It's great to take a flyer on the system, deposit your cash in the bank. It's much more convenient to get banknotes, or now, obviously, there's less and less carrying of paper notes anymore. But, you have an app on your phone, it transfers and, credit and all kinds of things. That's all very convenient and it's good for most people most of the time. But there is a time and there's a person who needs to physically take his marbles home and not take a flyer on the system. And that is if he doesn't like the terms that are on offer, he doesn't like the interest rates, he doesn't like the risk, doesn't like something. And in Bitcoin, suppose some new technology came out. One of the challenges I have for the Bitcoiners is in every other technological revolution, the first generation technology is long forgotten by the time the industry is mature. Um, but in the case of Bitcoin, it has to be Bitcoin that survives and becomes the winner. Because if it's anything else, then I used to say there was $1 trillion bet riding on it. Now I guess it's a 500 billion or $300 billion bet. It's gone down quite a bit, but there's a giant bet riding on that it has to be Bitcoin. And if Bitcoin proves not to be the thing, then So, anyways, there has to be a physical thing you take home. And when you look at all the things that you could possibly take home, first of all, it has to be fungible. That is, all units have to be the same as all other units. So that precludes diamonds or any kind of stone. Not only does it have to be divisible without diminishing the value of a unit, it has to be recombinable. If someone cuts it up into lots of little pieces, how do you get them combined back together in one big piece again? Which means it has to be a metal. So metal can be cut, metal can be melted and reformed. And then it also has to have reasonably high specific value. So I always like to use the example. Suppose, and I think on the first time you interviewed me, I held up a 400-ounce bar of gold, which is somewhat bigger than this phone. But if you had something the size of this phone, maybe just a hair thicker, this would be roughly 2 kilos of gold. Right, so 2 kilos of gold at today's prices, it's close to $100,000 in value. If you're going to try to take that amount of value home, and let's say crude oil, which is a commodity that people often liken to money, so it's a new currency, it's money, liquid money, etc. Well, you're talking about basically a swimming pool full of oil. And so you can't put that in your pocket anymore. You can't even put it in a backpack. It becomes enormously inconvenient. Not to mention, oil is toxic, volatile, extremely flammable. It perishes when exposed to sun and oxygen, and on and on. It requires special storage, special handling. It's dangerous. Um, so of all the things that you could physically take home that has the properties we just described, you're down to a metal. And of those metals, especially ones that were available in the ancient world, there's one of them that is heavier than the others, doesn't tarnish, is really malleable, et cetera, et cetera, et cetera. It's gold. And so once gold becomes, so my definition of money is the most marketable commodity, marketability being the measure of what your losses are. So you're selling some sort of other goods using money as an intermediate step. You're selling your goods for money, and then later you're using the money to buy another good. There's a loss implicit in that, and that's the bid-ask spread. And so the wider the bid-ask spread, if you were to use dried fish or salt, for example, the spread's much wider. So that's the loss you take every time you do a round trip. You're looking for the thing with the least losses, the narrowest bid-ask spread, which is another way of saying the most marketable. And so it's the physical good that is the most marketable physical good, and that's gold by far.
All right, it's a great explanation. Thank you for that. But hey, speaking of money, or what by default we know as being money, the digital dollar is undergoing trials. What's your opinion on this digital dollar? I mean, what is it meant to accomplish?
So I haven't read about the specifics of the trial, but I did read the Fed's position paper. I don't know if that was a year ago or some time back. And they talk about it's kind of funny. They have to square the circle, and they walk this tightrope between, on the one hand, saying it's less risky than holding a commercial bank balance, and on the other hand, the commercial banks being regulated are perfectly safe. So the banks are perfectly safe, and this is safer than the banks. Um, and there's all this stuff about people are going to trust the Fed and this and that and the other thing. I think obviously there is a huge privacy concern when you think about the government is going to know every transaction that you do. And as we see in China, if they have any kind of social, credit score, they could decide, you don't get to buy that because. So China, there was a pro athlete, I don't want to say basketball star, but I may be mistaken, that was denied going to the Olympics, I think, or something, denied passage on the high-speed train because his credit score was low, so he's forced to take the low-speed train that stops in every stop, so all the other athletes can get there in 2 or 3 hours, and he takes 27 hours stopping at every stop along the way, going 50 miles an hour. So they can deny you don't have the right to buy that. They can get into your diet and health, and well, Keith, you're a little overweight. You don't get to buy McDonald's today because we're controlling you. And then obviously after the fact, they can audit it, say, you gave money to those freedom truckers in Canada. So now look at this array of things that we can do to you. So I think that's really Orwellian. But I think and no doubt there's lots of people in the government that are, salivating with glee at the prospects of this. But I think the driver of it is they all kind of sense that negative interest rates are coming. And I know that right now, in fact, Powell just a few hours ago said another 50 basis point hike. The bond market ain't buying it. The 10-year Treasury yield is falling. Um, and so he can further invert the yield curve, but I don't think. So I said the same thing in 2015 as I say now, that they will not be able to durably raise rates. That they're going to raise rates for a bit. They're going to precipitate some sort of crisis. In response to that crisis, rates are going right back to where they had been and even lower. So with the coming of negative interest rates, you have a real problem, which is a run on the bank, right? So as long as the interest rate is at least zero, nobody has any real reason to withdraw money from the banks. Um, whatever the risk in the banking system, the government and the Fed will bail it out, unlimited. So there's no real reason. But when interest rates become negative, your bank balance is actually diminishing. You have $1,000 in the bank, and by the end of the year, if the interest rate is -2%, you have $980 left. They're taking money out of your account. So there's a point at which, now I don't think anybody would do this for minus 0.1% or minus 0.2%. But if the rates get negative enough and nobody knows exactly where that line is, at some point people say, you know what, I'm just going to withdraw all my paper because paper has a zero yield. It's not negative, not positive, but it's not negative. And so that's a run on the bank, and that will destroy the commercial banking system. So the Fed is saying, okay, looking beyond the commercial banks, which are going to have to evolve into some other form. They're not going to be able to get retail deposits anymore. How do we keep the system going? How do we kick that can down the road? And so We're going to declare some sort of digital. I dubbed it. This wasn't the term in their paper, but I dubbed it the Fed coin, capital F, capital C. Sort of pseudo cryptocurrency. I don't know what technology they might use. It doesn't matter, but it'll be a direct account that everybody would have at the Fed. Then they can say that paper is no longer legal tender after this date. Whatever notes that are circulating will not be depositable in a bank anymore. Will not, you never get credit for it anymore, and demonetize the paper notes. And now everybody has to use this digital Fed coin. And then when interest rates are negative, they can set a corresponding negative rate on the Fed coin. You're trapped. There's no longer any way to opt out. So I think that's the real driver of it is negative rates are going to wreak havoc, and this is their game plan for. They can't really fight. Economic law is what it is, but they can stave off or mask symptoms, put pennies in the fuse box. There's a lot of things they can do that seemingly create, the patient. So to take me, I'm overtired and sleep deprived and jet lagged, so I could pump up on caffeine. And when that's no longer sufficient, then I can pump up on Red Bull. And when that's not sufficient, presumably turn to cocaine and, stronger and stronger drugs. That's kind of what they do, to kind of stave off the inevitable bust that comes from all of this, loose credit policy that they've imposed.
You mentioned the yield curve, and I was taking a look at it, and the 1 month is offering more yield. 1 month treasury is offering more yield than the 30-year, 20-year, 10-year. I think even all the way down to the 7. What does that tell you, or what should it be telling the average Joe or the investor out there?
That demand for credit has fallen off a cliff. There's little to no issuance of longer term bonds other than by the government itself. And so at the same time, lots of investors think insurance companies, uh, pension funds, there's a lot of institutions that need to match or try to match the duration of their liability to the duration of their asset, that need to invest in longer term things. And so there's a surplus of demand, a deficit of supply, and a lot of other things going on in credit land. I'm way oversimplifying it, but basically, economic law attempting to reassert itself in light of the Fed's, now I'm going to say mad attempt to raise rates. I have to preface that whenever I talk about Fed policy, there is no right policy. I'm not saying the Fed should lower rates. I'm not saying the Fed should fix rates at a static level. But each thing that the Fed does has consequences, all of which are negative at this point. I gave a talk in Vienna this summer, well, summer in the Northern Hemisphere anyway. And the talk was the Fed is in, the German term is Zutzwang, which is a term also used in chess. Basically, every move that you have to make a move, and any move that you want to make, any move that is legally possible to make, is a bad one that weakens your position. So Fed is trying to hike rates right now, and the consequence is they can control the overnight rate, which to a large degree pulls up short-term rates like the 1 month, but they don't have control over the longer-term rates. I think the term is pushing on a string, and so then you get this inversion. They can't push the entire yield curve higher nearly as much on the long end as they do on the short, and so then you get inversion and all kinds of perverse things going on. So that means that banks are losing money on interest. The Fed itself is losing money. All kinds of bad shit is going on as a consequence of that.
Speaking of losing money, when we saw yields rise a little more than a month ago in the UK, we saw sort of a pivot where the Bank of England started buying back government bonds. Can this happen with the Fed as yields continue to rise? We see pension losses in the US and the Fed sort of throw in the towel and move back into buying US government debt.
I think for a variety of reasons, the U.S. financial system is, I wouldn't necessarily healthier. I always prefer to say less sickly than say in the UK. It's not good, but it's maybe less bad. Um, And so in the UK, the pensions were all about to go insolvent because of the use of leverage, the use of assets they shouldn't have been using, and so on. And so the Bank of England said, okay, even though they nominally maintain a posture of quantitative tightening, they effectively have to loosen, at least for the benefit of the pension funds. Otherwise, they're going to get one of those crises that I referred to earlier. I think eventually things like that will happen in the U.S. Again, the U.S. is perhaps a little less sickly, so therefore a little bit more robust to the new drug of tightening and the side effects on the body that will occur.
All right. Keith, I want to get back to gold because, when it comes to gold, do you think most people understand not just what gold is, but what gold can actually do?
I think that I'm sure I'm going to piss off some of my fellow Americans in saying this, but I think I get the right to say this, being an American and having traveled as much around the world as I have. I think Americans understand gold the least. I think most Americans either don't think about gold at all, or if they think about it, they think it's a joke and they laugh at it. That it's the sort of thing that over the hill former celebrities are pitching in late night infomercials. Um, Usually selling either greed or fear, how rich you're going to get, and that guarantee the gold price is going to have to go up because the Fed is about to print, or fear the Fed is going to crash the economy and there's a threat to your family and your loved ones or whatever it is that they try to paint it to be. And so there's a lot of tarnish on the reputation of gold in America. That said, Americans are very fortunate in that we've never had a currency crisis. We've never had any serious reason to question keeping your savings in dollars. I mean, we had that episode in the 1970s, inflation being, 13% or 15% or whatever. The rest of the world would say, oh, 13%. Was that per year? Oh, that's cute. You think that was bad? Because there are places in the world where that's per month or even per day, you know. So in the rest of the world, I think people understand gold is for that portion of your savings that you don't want to have at risk. Whereas in the US, particularly, but in the Western world to varying degrees, they regard gold itself as risky. I mean, you could buy it at 1750 and its price could drop, oh my God, calamity, to 1700. And then what are you going to do? And, so there's kind of a short term thinking combined with, uh, kind of an implicit belief that the dollar is the unit of measure and gold is going up and down. Um, but I think before this is all over, even Americans are going to rediscover uh, that they've got it backwards.
What are perhaps two or maybe three of the biggest arguments you've heard against having gold? I mean, maybe you've heard it through the course of business, or maybe you've heard it at the debate. But what would you say they are, and how would you maybe counter or maybe even agree with it?
So I guess classically, gold is volatile, therefore risky, right? So if you're a regulated investment advisor, you're always under a fiduciary duty to use reasonable and prudent investments. And that doesn't necessarily preclude gold in the portfolio, but it would have to be a very small percentage, let's say low single digits, 1 or 2 or 3%. And the regulators probably wouldn't give you too much grief for that. Again, I think they have it backwards. It's actually the dollar that's going down and up, not gold that's going up and down. Um, then, of course, and this is our favorite of monetary metals, because we pay interest on gold. And we wrote an open letter to Warren Buffett, but there's what I call the Warren Buffett objection, where he says, gold doesn't pay a yield. You buy a lump of metal, you stick it in your desk drawer 20 years later. Not that anybody would put gold in their desk drawer, more like they're safe. But, you take it out 20 years later, it's still the same lump of gold, being neither productive nor procreative, doesn't earn a yield, blah, 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 blah. And of course, we wrote this Dear Mr. Buffett letter. You were correct, but no longer monetary metals pays interest on gold. By financing productive things, that's the kicker to it. So we've overcome that challenge. Then the modern one, the Bitcoiners seem to, and I use the word pivot. So pivot is when somebody makes kind of a lousy argument, and then they run into where somebody actually debunks the argument and answers it properly. The pivot is when somebody doesn't acknowledge that the argument they just gave, which presumably is their best argument, why Bitcoin? Well, because whatever, and that's their statement. Period. Full stop. And then it gets debunked. They just don't acknowledge the debunking, and they just smoothly move on to the next argument, as if the first one was never asked and said and answered. And so the Bitcoiners have pivoted on now to this idea that Gold is centralized. Bitcoin is decentralized. Gold, therefore, because it's centralized, it's going to be confiscated, and there's the whole miasma of, different syndromes that they allege all come out of this. And of course, they have it exactly backwards. I mean, they don't read history, so they don't know this. The whole point of gold, as I was saying earlier, is that you have the right to take your marbles home. And it's the opposite of centralized. The dollar is centralized. Gold absolutely is not. Anybody can, and back in the old days, workers would get their wages counted out in silver, um, and have the right to take that home and deposit it if and only if the banks were offering a good deal with good risk. So they they come up with this ahistorical, argument, and they say, well, gold is heavy. It's very value dense. This piece of gold would represent probably more than the life savings of 90% of the people, 95% of the people on this planet, and you can stick it in your pocket. I mean, 2 kilos might drag on your trousers a little bit, but you could, right? It's very portable. It's very value dense, and they say, well, it's hard to spot a fake. So in that debate, I actually took out a gold coin I had in my pocket, held the microphone to the table, dropped the coin on the table, and you could hear the ring. Gold is a very unique ring. There's no other metal that comes remotely close to that sound. Certainly not a fake, which would be tungsten or lead or something. We go thunk versus ting. Um, and so those are three arguments right there.
All right. Keith Weiner, before we wrap up, can you tell us about monetary metals and how people can follow you on social media or perhaps contact you?
So I'm at Real Keith Weiner on Twitter. Our website is monetary-metals.com. Dash is important. Um, and we, uh, provide accounts people can open, and it's a conventional storage account like anybody else. But the difference is we then present opportunities to lease the gold out, and we actually pay interest on it. So instead of paying storage costs, people can earn interest on their gold. And for people that have decided to own gold for whatever the reasons may be, uh, we think it's a pretty attractive proposition to be able to get paid on that gold and earn some more gold. So lease rates tend to be in the 2 to 3% per annum range. The leases are, we do everything we can to make the risk as low as possible. That is for inventory and work in progress. If the gold is physically present, we could go to the lessee, scrape all the gold, put it on a scale, and it would be greater than the lease amount. It's insured. There's a lot of other things we do. And then we have another program for accredited investors. Interest rates can be much higher. We just announced a bond. So we have issued the first gold bonds since President Roosevelt broke the gold standard in 1933. The point of which, by the way, wasn't to steal the gold. It was to break the gold standard so he can get control of monetary policy, which the government didn't have full control over in those days. So since 1933, there was nothing, gold was not used to finance production. And we issued this gold bond uh, and then another. And the one we just did is paying 19%. Obviously, much higher interest rate than the leases, much higher risk. It is a public company that's listed in Norway, but it's for a mine, and the mine is in Ethiopia. So obviously, there's real risks there that you can't just wave your hand and say, "Oh yeah, that's there's no risk." I mean, there definitely is, but we think well mitigated, and we think that's a fair and appropriate interest rate for it. And we have a variety of things kind of in the middle as well.
All right, Keith Weiner, we appreciate the time you've given. I hope we can do this again soon, and I look forward to seeing more of your tweets and hopefully debates. Do you have any more debates coming up?
Um, there's a possibility I'll do another debate either around modern monetary theory, which I'd love to dive into that, um, and or there's a whole movement where they call themselves for sound money and capitalizing on that term. But what they mean is to advise the Fed on the best way to centrally plan the dollar. And so they're saying, no, no, look, the Fed has it all wrong. You're centrally planning the dollar based on inflation and unemployment. That's no good anymore. You should be centrally planning the dollar based on GDP targeting. And that they call that sound money, which to me is an affront to the language. I think George Orwell had a few things to say about that. And so I may one day look forward to debating one of the leaders of that movement and get into that in a little greater detail.
We'll look forward to that one. But Keith, again, we thank you for your time. I know it's early for you here in Singapore, so we'll let you get started with your day.
All right, thanks so much.
That was Keith Weiner from Monetary Metals sharing his view on the economy, the dollar, and gold. To see more of Keith's work, please visit monetary-metals.com. If you like this interview, please remember to subscribe, hit that bell to be notified, and give us a thumbs up. They really do help us out a lot, and we greatly appreciate it. Audio-only versions of this interview can be found on iTunes and Spotify.